welcome on board Shrudeep Bhattacharya, President and CIO Equities at Edelweiss Mutual Fund, joining us on the show right now. We'll talk about with him on the markets and what is the way forward. And Shrudeep, great to have you on ET Now. Thank you so much for your time. And what a great day to have you indeed, because markets are definitely cheering the official announcement when it comes to the ceasefire. And well, of course, globally, the things are looking a bit cheerful in terms of the tariff announcements and the trade talks. Give us some sense from here on. Where do you see the markets headed? What cues you are getting from the earnings? And overall, what's the outlook and sentiment building for the Indian markets?
Good afternoon. Thanks for having me on your show. I think at the outset, my condolences are with the families who've lost their loved ones in this attack and the war. And salute to the armed forces with the precision with which they've carried out Operation Sindhu. Stand with the nation. In the context of markets, I would say that the market since the beginning of this year has moved from an era of maximum uncertainty, where Trump's plans were not known, our own spending plans were not known, earnings were weak, to a situation where Trump's plans are known, broadly known. India's spending plans are broadly known. The only thing that is remaining to be in place are the earnings forecasts or the earnings estimates of India Inc., which might take a couple of quarters more. So if you see the rally in the markets which have come from, which has happened from roughly about Jan, Feb, Med to now, it broadly reflects coming out of macro uncertainty and still kind of, we are lower than all-time highs. Is a symbol of the fact that earnings estimates have still not kind of made it up there. Through this process, actually, at our end, we have been kind of positive, relatively positive on the markets. We have held very little cash in our portfolios. But we think that the macro-based rally is broadly done. Going forward, it'll be closely related with regards to earnings estimates coming back and forth, which we think that will take a couple of quarters more, broadly by second half of fiscal year 26, when earnings starts to kick in gear.
Sudeep, this is Ankita also joining in. Good afternoon to you. And I'll take a leaf from what you just mentioned that, perhaps from the second half, we will see better earnings. Also, we have, the impact of the rate cut coming in, the liquidity infusion, and also a big positive fillip to consumption is the easing of the Brent crude. All of this is likely to kick in the second half of this year. Tell us, how do you see the second half panning out? What are you expecting? And therefore, what are the sectors that you will be watching out for, the sectors that might lead from the front?
Great question. So I would say that the three positives amongst the whole barrage of negatives that we've seen from the macro front over the last 3-4 months have been, one, that crude oil, which we as India are a big importer of, has corrected 25% plus over the last 3 months. Second, inflation has started to come down. And if monsoon forecasts are anything to go with, it looks like that coupled with that, inflation might actually head lower. Third, we have already seen 50 basis points of rate cuts, and the hope is that there is more to follow as we go towards the back half of this year. And finally, we shouldn't forget the budget bonanza that we got from Honorable Finance Minister, which effectively means a salary hike of close to about 5 to 7% for middle income earners, which will be effective from April, but probably will help in consumption as we get to the back half of this year. So on net balance, these four factors put together, I would say that the ducks are lining up for the consumption sector, particularly in the back half of the fiscal year. And that's certainly one of the areas where we are overweight, and we continue to, at every weakness that we see, we add our weightages in the portfolio. The second sector that I would kind of bring to your notice is basically financials, and within financial, NBFCs, non-banking financial companies. Here we think that valuations are still reasonable, growth resilient, and they would be beneficiaries of rate cuts as it starts to impact earnings in for the rest of the calendar year. So that's a second area where we think in broadly financials and within financials, NBFCs as well, which we are overweight on. and we think that they would kind of, could see better days from an earnings standpoint. The third area that I would point to is tires, or basically on the subsegment of consumer discretionary, where we think that given that crude oil has corrected quite a lot, the industry structure is fairly stable, little capacity coming on board. We think that this sector could see supernormal earnings from a margin standpoint coming through as we get to the back half of this year. So those would be three areas that we in our portfolios have taken a positive view on and increased our positions over the last few months.
Well, no doubt that all the three areas that you have mentioned, they have been performing very well already, and especially since I track autos, I can comment on tires, given the margins and given the outlook, that sector is indeed holding up well. But to the defense as a pack, that has done well in the recent time. Well, of course, there's a sentimental impact that is already coming through all these stock prices as well, given the Indo-Pak tensions. But structurally, Trideep, how do you see this story panning out? Because we have already seen a multi-bagger return in all these counters. At one point in time, there were concerns around the valuations, but with now this theme picking up, what's your sense and what will actually drive the stock prices higher from here on?
Yeah, so we are structurally positive on defense. We are overweight in our portfolios. But the reason I didn't want to mention that upfront is because I think quite a bit of, from a near-term perspective, given the circumstances that we have been in from a geopolitics standpoint, I think the share prices reflect a good bit of positivity. It might take a little breather in the near term, but that is not to say that we are not positive on defense companies. I think India's allocation towards budget, particularly as it goes on to become an economic superpower in the context of the globe and asserts its influence, will have to increase from where it is. And particularly in the context of our friendly neighborhood, it might be higher on a sustainable basis. But however, from a near-term perspective, I think the valuations capture most of this. While from a 3 to 5 year perspective, there is a lot more room to grow.
Right. Trideep, so you've spoken about the themes that you are overweight on. Talk to us about themes that you're underweight on, or perhaps you have taken off cash off the table as far as these bets are concerned.
Yeah. So I think in terms of the areas that we are not very constructive on is certainly oil and gas as a sector. Is something that over the last 3-6 months, we've actually kind of, taken money off the table on a cyclical basis. But structurally, if you ask me, we have taken money out of those sectors where we see more competition coming in and impacting the profitability of the companies. Notably, here I would mention paints as a sector where, over the last 2 or 3 years, we have seen good amount of, capacity coming in, and probably more so going forward, that might curtail the profitability of the sector. So that's the second area that where we would be underweight, although it's consumption. And the third would be metals and mining. Even though cyclically kind of stocks keep doing well off and on, we think that structurally there is enough overcapacity in the globe where which will kind of curtail the long-term positive moves in the sector in our view. So those would be the areas that we would be underweight.
But Trideep, given the market up move today, see a lot of things are getting factored in with respect to some respite coming in on the Indo-Pak tensions. Markets are finding a bit of a resilience in that fact. Other than that, it's the trade talks because markets are forward-looking, though we are waiting clarity on the US and China tariffs and what kind of an announcement comes through. But indeed, the announcements are in place and the parties are a bit constructive on that. The FIs are also making a comeback. But what are the areas, Trideep, that the markets must be ignoring right now, which could actually dent the up move that we are seeing right now? Any factors that you wish to highlight?
Sure. So the first thing I would say that if you look at markets broadly speaking, before 22nd of April, it's at similar levels to where it is right now. So effectively, the markets have kind of come around to realize that, okay, we've faced an issue and we're kind of gradually nearing an end. And the relief factor is kind of, a function of that. But if you ask me, the big risk factor in the back half of this year is basically a US recession. driven by overdoing of the tariff card by President Trump. You see, while they are good negotiation tools to get the best deal possible for United States standpoint, ultimately it brings about a higher inflation, and that could get them into a bit of a stagflationary scenario, which will be negative ultimately from an economic standpoint and from a market standpoint, and that at current levels I certainly feel is not factored in.
Before we let you go, one last question. Talk to us about the pharma pack. The news that has come in on the pharma pack. Tell us, how is that likely to impact the Indian pharma companies? Will we be able to climb the walls of worry now?
So I think with regards to, I'm sure you followed from first week of April till now, the way the tariffs have panned out. First comes the narrative, and then we kind of gradually soften the narrative to get to a deal which is constructive and doesn't hurt business sentiments to the core. So if narrative were to go with, I would say it's very drastic and would impact profitability quite significantly. But to what extent will this get diluted as part of negotiations is something that we need to see, and I'm hopeful that it will go in that direction, like it has gone in many other sectors like autos, which have preceded this one altogether. So I think net, there is probably next fortnight or so we will see a good round of volatility in the sector, but after that I think better sense will hopefully prevail. And hopefully business models don't get impacted, even though profitability might move up or down a notch. But net, this would be probably a shade negative for pharma as a sector.
All right, Sudeep, with this, we let you go on that. Thank you so much for taking the time out and speaking with us. It was good having you on the show today.
If you like this video, then like, share and subscribe to ET Now.